Hello everyone, welcome to week 2. This is Jake Adams, CPA. I am going to be talking today about reasonable compensation for an S corporation. Now, reasonable compensation is the number one reason that you want an S corporation. And right now we're going to be talking about what it is, how to calculate it, and how to pay yourself a reasonable compensation so that you are protected against IRS audits that would potentially look at your potential abuse of the reasonable compensation. So let me do a quick screen share here, and we're going to be talking about why a S corporation has great benefits for the reasonable compensation, where the savings come from, and how to protect yourself and how to do it right. All right, so here we go. We are going to jump into my screen. There we go. All right, so what I'd like to do is check out a website called Glassdoor.com. Now, this is the easiest way of doing a reasonable compensation report. And you can do this for a lot of different careers, a lot of different positions. So let me give you a quick example here. I'm an accountant, so I'm going to put accountant, and I live near Livermore, California, so I'm going to put Livermore, California, and I'm going to look up salaries. And what this is going to do is this is going to show me what I would expect to earn as a careered accountant working for a company, a job, a salary. All right, so what does this mean? So let's take a look at it. We have here accountant salaries in San Francisco, California. The national average is $54,000. The San Francisco, California area average is $65,819. So let's round that up to $66,000. So why is this important, and what does this mean? Well, what I want to do is quickly jump into Excel and show you why the S corporation has huge benefits. So let's say that your revenue coming in to your S corporation, so let's say your revenue is, let's say $100,000, right? Easy enough. So your revenue is $100,000, and you get to have expenses, right? So let's say your expenses are $20,000. I'll make all these. There we go. All right. So you have revenue, expenses. This is your, let's say, your margin or your income. Whoops. Income. So your income is $80,000. Okay. So now what you get to do is, as an S corporation, take reasonable compensation, and the reasonable compensation is going to protect you against the Social Security and Medicare taxes. So what does this mean, right? So our income is $80,000. So if this was a self-employed or a sole proprietor, okay, then you would have $80,000 times 15.4% Social Security and Medicare taxes. So we'll call that self-employed taxes, or SE taxes. And SE taxes is Social Security and Medicare. All right, so wow, $12,000 or more than $12,000 of additional taxes. That is crazy. So by doing the S corporation, what we can do is we pay ourselves a reasonable salary, and we also get to pay ourselves dividends, okay? So in this case, we have $80,000, but we just looked at the Glassdoor website, and I found out that a reasonable salary for an accountant was $65,000, $65,800. So let's roll it up to $66,000, $66,000. Well, the difference between the reasonable salary and the income is a difference of $14,000. So that means I get $14,000 of dividends. So my S corporation income is $80,000, right? So what's the difference between dividends and salary? Well, salary, if you are earning that as an employee or an employee of an S corporation, you have to pay Social Security and Medicare taxes on it.
So what we'll do is we'll look at the same thing. What is the self-employed taxes for our reasonable salary? So our self-employed taxes would be based on, here we go. So here, $10,000 of self-employed taxes. Again, self-employed taxes are Social Security and Medicare. But what we're most concerned of is the difference. What is the difference between the sole proprietorship and the S corporation? And the difference is $2,000. So how would you like to put $2,000 back into your pocket every year? Yeah, not too bad, right? Now, this is just one example. We could play around with the numbers where this could actually be even higher, right? So this is just one example. Let's say that we're making a little bit more. So let's say that we're making $140,000. So let's say our revenue is $200,000, and let's say our expenses are $60,000. So our income is 140 grand. So 140 grand, our self-employment taxes are going to be $21,560. But with our S corporation, again, our income is 140. But let's say our reasonable salary, let's say we're doing a little bit better, right? So I don't know, let's say that we a little bit more experienced, we know what's going on in the business. So let's say our reasonable salary is $80,000. So our dividends would be the difference between the 80 and the 140, or $60,000. What's the difference here? Well, the difference here, you can see self-employment taxes with a $200,000 revenue to 140 in income. So self-employment taxes for that is over $21,000. Here on the S corporation, it's only $12,000, or a savings of $9,000. So the most important thing we're looking at here is your reasonable salary has to be reasonable, but we want to maximize the dividends, right? So how can we reduce the reasonable salary? Well, we can reduce the reasonable salary because I'm not always acting as an accountant, right? As a small business owner, you're wearing 12 different hats. You have advertising, marketing, bookkeeping, janitorial. You probably clean up after yourself, after your office, right? So what we can do is by looking at a 40-hour work week, we can break that down into some of the lower salary tasks that you do as a small business owner. So in my case, let's say I spend an hour a week cleaning up, doing janitorial. And let's say I spend 10 hours a week doing advertising or marketing. Let's say I do 5 hours a week customer service, answering the phones, mailing things out to my clients, more advertising, marketing. So by doing items like these are lower rates, right? If I hired someone for customer service, I'd probably spend anywhere from $10 to $20 an hour. So when we're looking at that, that's a much lower rate than a $65,000 or $66,000 accountant for the year. So what we're going to do is we're going to actually set up an Excel sheet where we can look at salaries for the different items that you're doing, right? So it's advertising, bookkeeping, janitorial, website development, things like that, the other things in your business that you're doing, because as a small business owner, you're wearing so many hats. And what we can do is by looking at this, we're going to figure out how many hours you spend doing those particular things, and that's going to actually reduce our salary. And by reducing the salary, you guessed it, we're increasing our dividends, we're lowering our self-employment taxes, which is going to put more money back into your pocket. All right, so we're going to go through that again. The goal is to reduce your salary, which is going to increase your dividends, which is going to decrease your self-employment tax, and which is going to increase the amount of cash that you take home, or the more money in your bank account. That's the goal. All right, so a couple things. Can you pay yourself zero reasonable salary? No, because $0 is not a reasonable salary. If you came to me and asked for a job, and I'd say, okay, I'm going to pay you a $0 or $1, is that reasonable? No, you need some sort of compensation for the work that you're doing. So $0, $1, it's not reasonable. We have to kind of do the paperwork here. We have to look at the number of hours that you spend in the business, the different things that you're doing, and find the reasonable compensation of what you are doing, and making sure that you're getting reasonably compensated for the activities that you're doing. Okay. If you don't have any profit coming through your S corporation, you do not have to pay yourself a salary. So if let's say you just started with your business, you lost $5,000 this year, do you have to pay yourself a reasonable salary? No. You do not have to pay yourself a reasonable salary if you do not have a profit. Now, once you do have a profit, you do have to pay that profit in reasonable compensation up to the point where you have dividends, like we looked at with the example. So the example and the benefits only come when you have profits, right? And the profits can be given back to you in the form of a dividend. Okay, so a couple case studies, a couple IRS court cases that I want to cover with you. The first thing I want to cover is the Davis case. So Davis was an orthopedic surgeon. And as an orthopedic surgeon, he had two corporations. He had an x-ray company and a physical therapy company. So what Davis did is he actually had his children that were running those other companies, the S corporations. And what he was doing was he was passing through or having the money flow through either a self-employed business into an S corporation or from one S corporation to another. And this is totally okay. The IRS courts, the tax courts actually sided with Davis in this case, with the taxpayer, so that he was able to push the income through S corporations, and it wasn't actually him that was earning the revenue. So how this comes back to reasonable compensation is you only have to pay your reasonable compensation for work that you're actually doing. So going back to what we were talking about before with the 40 hours, the typical employee is going to work 40 hours. If you work more than that as a small business owner, you might be not. But if you work more than the 40 hours, then you get to pull that money back. No, that didn't sound right. So if you work more than the 40 hours, you have the ability to only look at 40 hours and only compensate yourself for those 40 hours, which is the traditional employee. Now, if you work fewer than 40 hours, let's say you have multiple businesses, you can only work 15, 20 hours in each business. So when you work 15 or 20 hours in each of those businesses, you can pay yourself that reasonable compensation for those hours that you do work in that business or in each business. And you can have multiple S corporations. That's totally fine. Okay, I think that's it. All right, so that is going to wrap up the S corporation reasonable compensation. And the biggest benefit, which is worth thousands and thousands of dollars by looking at the S corporation, paying yourself a reasonable compensation and taking the profits as dividends. One other last thing to note is that one other thing that I'd like to point out is that the S corporation is referred to as a pass-through entity. And what that means is that all of the income every year passes through to the shareholders 100%. What that means is that if the S corporation earns $100,000 in profit, then $100,000 is passed through to the owners at the end of that year, calendar year 12/31. So that means that each of the shareholders has to have that income or report that income on their personal tax returns. So let's say you have an S corporation where you have a 50-50 partner, right? And they earn $100,000. Well, the $100,000 is going to go $50,000 to shareholder A and $50,000 to shareholder B at the end of the year, 12/31, to report on their personal income taxes.